Hey there, traders. I'm Charles, your AI guide here at Pipdemy. Today we're diving into a fascinating and often overlooked tool in the world of technical analysis, the Fractal Indicator. Fractals can reveal market turning points, highlight structure, and help you trade with greater confidence. If you're ready to see patterns inside the chaos of price action, let's begin. A fractal in trading is a recurring pattern based on 5 bars or candles. The middle candle is either the highest high or the lowest low, and it's surrounded by 2 lower highs or higher lows on each side. This forms a visual pattern that marks potential reversals. Just like snowflakes or coastlines, markets also exhibit fractal behavior, repeating structures at different scales. The idea is simple. What happens on a 5-minute chart can also happen on a daily chart. Fractals help you read these patterns and spot opportunities in the noise. A bullish fractal appears when the middle candle has the lowest low and is flanked by 2 higher lows. This can signal a potential bottom or buying opportunity. A bearish fractal is the opposite. The middle candle has the highest high, with 2 lower highs on either side, pointing to a possible top. Most platforms like MetaTrader or TradingView display fractals as arrows above or below candles. Up arrows mark bearish fractals, down arrows mark bullish ones. They don't predict the future, but they mark key areas to watch for action. Fractals are excellent for spotting swing highs and swing lows. By connecting these fractals, you can map out the structure of the market. Are we in an uptrend, downtrend, or range? When price breaks a previous fractal high or low, it can signal a trend continuation. This makes them useful for confirmation after pullbacks or during breakouts. Combine them with moving averages or trend lines for even stronger signals. You can use bullish fractals as buy signals near support or after a pullback. Bearish fractals can be used as sell signals near resistance or during retracements in a downtrend. A great tactic is to place stop losses just above a recent bearish fractal or below a bullish one. They also help identify natural take-profit zones by targeting the previous swing fractal. The Fractal Indicator is part of Bill Williams' system and pairs beautifully with the Alligator. Use the Alligator's moving averages to define trend direction. Then look for fractal breakouts in the direction of the trend. Combining fractals with oscillators like RSI or MACD gives you even more edge. If a bullish fractal forms at an oversold RSI reading, that's strong confluence. Or if a bearish fractal aligns with MACD divergence, watch out for a reversal. Fractals only appear after the 5th candle closes, which makes them a lagging indicator. They confirm key areas, but shouldn't be used alone for early entries. On lower time frames, fractals can be noisy and give too many signals. To avoid false setups, filter with trend direction, support, resistance, or volume. Look for a series of bullish fractals forming higher lows, then wait for a fractal breakout above resistance. This creates a clean trend-following setup with a tight stop under the last fractal. Say price is approaching a major resistance zone. If a bearish fractal forms there with divergence on RSI, that's a strong reversal clue. Fractals help you see the turning point, not just guess it. Nice job, trader. You've just unlocked the hidden power of the Fractal Indicator. It's simple, yet surprisingly effective when combined with other tools. Remember, fractals are not magic, but they highlight structure, and structure is the backbone of price action. Use them to confirm trends, identify swings, and refine your entries and exits. And I'll see you in the next lesson.